Is there a buy the dip opportunity coming in the Australian market? And when is that going to take place? My name's Luke and I run a Brisbane buyers agency called Purpose Property. If you're looking for help to buy in the Brisbane market, head over to purposeproperty.com.au and let's talk about buying the dip in the Australian market. In my opinion, there's three key areas which give us insight into what's happening with property prices and how we can potentially time the property market. The first area to look at is the history of Australian property prices, what's happened in previous recessions and pullbacks, and in previous interest rate rises. Now, overall, as I'm sure you can tell, housing has been seen as a very safe investment. Safe as houses is the term. Now, property has been a very resilient market and hasn't seen major declines even in major economic events like the GFC or the decline around 2017 to 2019 from changes in lending policy. That last downturn in property prices, especially in Sydney and Melbourne, between mid-2017 and mid-2019, we saw a slide in property prices around about 10% in that time period, with Sydney and Melbourne leading the charge on the decline, with Sydney falling roughly 15% and Melbourne falling around the 11% mark in that period around 2018-2019. This was due to the squeeze from APRA at that point in time and the difficulty of people being able to service debt and people being able to obtain that debt to make investment or homeowner purchases. The last big decline in property prices before that was around the global financial crisis, which saw price declines around the 8.5% mark nationwide in that 2008-2009 period. This is based on the data provided by CoreLogic, which is a national researcher of property prices and collating property information. So when speculators are talking about events of 20, 30 or 40% decreases in property prices, this is purely unprecedented. Based on the major declines we've seen in the last 20 years, we can't see more than a 10 or 15% decline from major events. In 2017 to 2019, we saw that 10 to 15% decline depending on the location, and in the GFC between that 8 to 10% again. Nothing like 20, 30, 40, 50% declines that some economists and some speculators are saying might happen in the property market. I can certainly see those inflated markets having larger pullbacks, where property prices are getting away from the actual rebuild cost of the home. But for more affordable areas and locations like Brisbane, like Perth, like Adelaide, where the house prices are closer to the rebuild cost, that's where I can't see there being a larger decline more than that 10 to 15% mark in a worst case scenario. And we've already seen declines so far this year in 2022 around that 5% mark. So going forward, I think we could see up to a 10% decline nationwide from the peaks of property prices. This leads me into area number 2, which has the largest effect on property prices, which is interest rates. I'm sure you've been following along with the news, and every time an announcement comes at the start of each month from the RBA's meeting, there's a lot of media hype about movements in interest rates. And what we're seeing is the RBA be aggressive with those 0.5% increases to try and get a handle on inflation. Now, the key questions here are when will the interest rates stop and what rate will they actually land at? Now, I think the timing, based on the media, based on what the RBA is saying, is that they're going to continue to have rate hikes towards the end of this year and will land at least 1% higher from where we are today. That will give us a cash rate of around 3.35%. This also means that the everyday homeowner will be paying around that 5.5% to 6% mark for their everyday mortgage on a standard variable rate. There will be some more competitive rates out there, and you can get fixed rates at the 5% mark at this point in time. So in my opinion, around that 5 to 6% mark will be the landing point for interest rates for the everyday Aussie later this year. As you can see on screen, we've got the historical graph of the cash rate target that's been provided by the RBA and the increases that we've seen over the last 4 months at a 0.5% change, basis point change, every month for the last 4 months, leading us to the current cash rate of 2.35%. Based on this graph, though, you can see that this isn't a very high rate relative to historical cash rates. And what this means is I think we have more headroom. The RBA is going to still want to get a handle on inflation and to stop prices rising too quickly. And one of the best ways for them to do that, or the main way that they can do that, is by increasing people's available cash by making them pay more for their mortgage. So that's why I think we're going to end up around that 3.35, around that 3.5% mark in terms of the cash rate towards the end of this year. You can see not that long ago, around that 2011, 2012 period, we had that 3.5% cash rate. And before that, the average rate was sitting around that 4 to 5% mark in terms of the RBA's cash rate, which means long-term interest rates were around that 7% mark for the everyday Australian. The cash rate rises, and the stopping point is what creates uncertainty in the market. When people don't have confidence around what interest rate they're going to be paying on their own home or their investment properties, they can't look to take action and see through the fog. But if we can get a good idea of where we think the rates are going, have buffers in place. I ideally like to use a 3.5% and 4% interest rate buffer, even though the banks use a 3% interest rate buffer when they assess you for your serviceability. You want to make sure you have really large buffers in place when you run your cash flows and your calculations to make sure you're confident about making your next investment decision, and so you can move forward with your next investment purchase. Given these factors, I think that interest rates will hit their peak around that 3 to 3.5% mark later this year, and then the RBA will stay stagnant for a period of time. This will give people more confidence around the cash rate being settled at a certain point, but people will definitely have reduced serviceability. So I can't see us having another boom period, but I think investors will be able to buy the dip if you can get in before other people realize there's more certainty in the market. A great example of this was when Emily and I bought at the very start of the COVID pandemic. We had our deposit in place, we understood that we were investing in property for the long term, and we bought in April 2020, which was the peak panic and peak uncertainty and lowest consumer sentiment in the market at that point in time. But we could see towards the long term, we'd run our calculations, and we were confident in investing in the property market for the long term. So if you can get into the market before the certainty returns, you might be able to buy the dip and get a discount relative to future prices for property. The third and final key area on my list to look at is location-specific factors when it comes to buying the dip. As we've seen historically, Sydney and Melbourne typically have the largest pullbacks, but they also have the largest buying prices. So you're looking at $1.5 million, even closer to $2 million for the average Sydney home, and Melbourne tipping that $1 million mark at this point in time. When you compare that to Brisbane, Adelaide, or Perth, these are relatively cheaper markets, so they're unlikely to have as big a dip as those major capital cities. We're also noticing in Hobart and Canberra that those markets are a little bit overcooked. Especially Hobart, the value that you're getting at this point in time is not comparable to buying in another major capital city like a Perth or like an Adelaide or a Brisbane. The other thing to remember here is we are coming off historic highs. The property market has grown 35, 40, 50% in some areas over the last 7 years, and so this is unprecedented. We're coming off these massive highs, so there's an expectation that there will be a pullback in property prices. The current situation is we are coming down off those historic highs and we are seeing a pullback around that 5 to 10% mark. So you need to factor in the location that you're looking to put your money. If you're buying as an owner-occupier or you're buying as an investor, you need to look at that major capital city. You then need to narrow down to the suburb and down to the street and what's been happening with property prices in that area. So it's really important to factor in what your goals are, what your strategy is, and what are the price movements in your specific city and your specific suburb when you're looking to make that next property purchase. So when is the right time to buy the property market dip? In my opinion, you might be able to buy the market dip around November, December 2022, because people will have a lull before Christmas. Typically people check out, they don't want to invest, they want to enjoy their holidays and they want to go enjoy their life. There will also be more certainty around that point, around property prices, around the cash rate that's being provided by the RBA. And based on the historical factors, we can't see property prices falling more than 10%. Now, of course, these things are all speculation and I'm not an economist, but I am a Brisbane-based buyer's agent. So if you're looking to buy in the Brisbane market and you want help buying your own home or investing in the property market up here in Southeast Queensland, make sure you book in a free strategy session with myself at purposeproperty.com.au. Let me know in the comments down below when you think the right time is to buy the property market dip. I'd love to hear your thoughts and have a chat with you in the comments. Is now the right time? Is November, December going to be a great time to buy the dip? Or should you hold off and wait till 2023 and see what happens with property prices? Make sure you drop a like on this video and subscribe to the channel down below and click this video over here for more things real estate, renovating and financial freedom. I'll see you in the next one. Peace.